Hi, do you know that over 42% of Americans have yet to invest in the stock market? And in Australia, close to half, 49% of Australians now own shares. That's right, most people are missing out on the opportunity to grow their wealth and achieve financial freedom. Today, I'm here to share with you the top 5 lessons from Warren Buffett that helped me achieve my own investing success. My name is James Lim from Stewardship Finance Academy, your friendly neighborhood online stock investment class instructor. In SFA, we have been helping people just like you to build their wealth and confidence in investing principles and strategies. Our channel is here to offer you all the important investing tips and strategies that will help you achieve your financial goals and make you the top of the town, or at least the top of your family gatherings. Have you ever wondered how Warren Buffett became one of the most successful investors in history? Well, you are in luck because today I'm going to review the top 5 lessons that contributed to my own investing success, as well as how they helped shape Warren Buffett's career. So sit back, relax, and get ready to learn some valuable investing lessons, and make sure you watch this video until the end. Let's get started. Introducing the Oracle of Omaha, the one and only Warren Buffett, the man who can make investing seem cooler than cucumber in the freezer. Do you know that Warren Buffett has been known to choke cherry coke like it's water? Yes, you heard it right. This financial mastermind has a soft spot for the sugary stuff, which just goes to show that even billionaires have their guilty pleasures. But don't let his love for cherry coke fool you. Warren Buffett has made some serious dough in his lifetime. He's a stock market wizard who has turned billions of dollars into even more billions of dollars. Let me tell you a little bit about him. Warren Buffett was born in 1930 in Omaha, Nebraska. He began investing at the young age of 11 and started his first real estate investment at the age of 14. By the time he was 30, he had already made over $1 million. Talk about an overachiever, am I right? Warren Buffett is not your average billionaire. He didn't make his money by inventing a new technology or selling a popular product. He makes his money by being a savvy investor. How did he do that? He had a mentor named Benjamin Graham who taught him the secrets of value investing. He also read a lot of books and studied the market. He didn't follow the crowd or chase the hype. He followed his own rules and stuck to them. And it worked like magic. He's now worth more than some countries. Now, I know what you're thinking. How can Warren Buffett's investing principle help you achieve financial freedom? Well, let me tell you. Surprisingly, his principles are simple yet effective. And these principles have changed people's lives. They have helped investors achieve financial freedom, retire early, and live their dream lives. In these videos, I'm going to share with you some tips and tricks that will improve your investments and make your life easier. Before we move on, I have a quick favor to ask you. Could you please hit the like button below this video? It only takes a second and it makes a huge difference for me and my channel. By liking this video, you are supporting my work and allowing me to create more videos for you. Plus, it also makes me happy and grateful for having such amazing viewers like you. Lesson 1. Be fearful when others are greedy, and greedy when others are fearful. Welcome to the wild world of stock investing. It's a world where fear and greed rules the roots. Fear of losing money and greed for more profits can make investors go wild with emotion. Fear causes investors to sell off stocks at a rapid rate, while greed leads to investors buying up stock at inflated prices. But what if I told you that there is a way to keep your emotions in check and make rational investment decisions? Back in 1987, when the market was soaring a new heights, Warren Buffett warned of the dangers of a bull market. He saw that investors were being overly optimistic and buying up stocks left and right without regard of their actual value. And what happened? That Monday hit, and the market crashed, wiping out billions of dollars in wealth. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." Now, you might be wondering, what the heck does that even mean? Well, let me break it down for you. When the market is booming and everyone is jumping on the bandwagon, that's when you should be cautious. Because when everyone is buying, prices go up and things get expensive. And when things get too expensive, they're bound to come crashing down. Therefore, when the market is bullish and everyone is buying, it's better to be cautious and consider selling. When the market is bearish and everyone is selling, it's better to be optimistic and consider buying. Warren Buffett believes that buying high and selling low is a common mistake that most investors make, which leads to underperformance in the long run. Many investors tend to buy high and sell low due to behavioral biases and emotional responses to the market fluctuations. Here are some of the reasons why people make this mistake. Number 1. Anchoring bias. Investors tend to anchor their expectations to the price they paid for the stock and use it as a reference point to make decisions on whether to sell or to hold the stock. For example, if they bought a stock for $100, they might hold on to it even if it drops to $50, hoping to recoup their initial investment. Number 2. Herd mentality. Investors often follow the crowd and buy stocks that are popular, leading to overvalued prices. Similarly, they may panic and sell when everyone else is selling, leading to undervalued prices. Number 3. Market timing. Investors may try to time the market by buying and selling stocks based on the short-term market fluctuations. However, research has shown that market timing is a difficult strategy to execute and often leads to underperformance in the long run. Number 4. Lack of patience. Investors often lack the patience to wait for their investment to grow and may sell it too soon due to fear and greed. Now, I know some of you may be thinking, but how can I avoid the herd mentality and not to be affected by fear and greed? Well, there are tools and resources available that can help. The Fear and Greed Index is a commonly used tool to measure the market sentiment, which is designed to capture investors' emotions of fear and greed based on a range of factors, including stock price movements, trading volumes, and market trends. Excessive fear can lead to stocks becoming oversold or undervalued, which can be a buy indicator, while unrestrained greed can result in stocks becoming overbought or overvalued, which can be a sell indicator. The Fear and Greed Index is a market sentiment indicator that can be found on various financial news websites such as CNN Money, MarketWatch, and Yahoo Finance. It uses a scale of 0 to 100, where a reading above 50 indicates that investors are more greedy than fearful, while a reading below 50 indicates that the opposite. To use this indicator, you can monitor the readings and use it as a tool to help you make trading decisions. For example, if the index shows a high level of fear, it may be a good time to buy stocks that are oversold or undervalued, while a high level of greed may indicate a time to sell stocks that are overbought or overvalued. However, it is important to note that the Fear and Greed Index should not be used as the sole basis for making trading decisions, and you should always conduct your own research analysis before making any investment decisions. Lesson 2. You shouldn't own common stocks if a 50% decrease in their value in a short period of time would cause you acute distress. Many investors find it disheartening to see their stocks, but Warren Buffett believes this reaction is irrational. As a long-term investor, Warren Buffett embraces market volatility and even welcomes seeing red numbers in his portfolio. Our favorite holding period is forever. This quote by Warren Buffett has become quite famous and reflects his investment philosophy. That's right, just like a bad tattoo, he's in it for the long haul. He's not interested in quick profits or catching the latest hot stock. No sir, he's all about finding good deals on great businesses and sticking with them for the long haul. And you know what? This strategy works. Warren Buffett welcomes lower stock prices as opportunities to acquire more shares of good companies. He doesn't panic when the market drops. He sees it as a chance to buy more shares at a discount. It's like when you find a designer handbag on clearance, you feel like you hit the jackpot.
Come on, give me the bag!
One example is his investment in Coca-Cola. Coca-Cola was hit hard during the Black Monday stock market crash in October 1987. Although nothing fundamentally changed with its business, Coca-Cola stock was trading at deeply discounted prices, and Warren Buffett saw this as an opportunity, buying more than 23 million shares between 1988 and 1989. Since the beginning of 1988, Coca-Cola's total return has been more than 5,800%. That is 58,000 for every 1,000 invested. So what's the lesson here, folks? It's all about commitment. Commitment to high-performing companies and not selling during stock market drops. It's easy to panic when the market takes a nosedive, but the best strategy is to hold tight and weather the storm. Now, I know some of you may be thinking, but James, how do I know which companies are high-performing? Well, my friends, that is where I come in. Let me give you some real-life examples of companies that have performed well in the long term. Do you know that if you had invested in Apple back in 1980 and held onto those shares until now, you will be a millionaire? And what about Amazon? And if you had invested $10,000 in the company back in 1997, it will be worth over $12 million today. Think about companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These are companies that have been around for decades and have consistently delivered for their shareholders. And when the market drops, investors can benefit by buying more shares at the discount. If you stay on and watch until the end, I will share with you Warren Buffett's 4 stock investment criteria to help you select the best stocks like this company. It is relatively simple to follow Warren Buffett's advice. It merely requires a change in perspective and the willpower to do so. By adopting a long-term investment strategy, you are likely to achieve better investment returns and, more importantly, you gain peace of mind. Lesson 3. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. It's like buying a burger that's just okay for a cheap price versus buying a delicious burger for a fair price. You always want to invest in something great, even if it costs a little bit more. In Warren Buffett's view, a wonderful company is one that has a strong business model, a competitive advantage, a capable management team, and a promising outlook for growth. But what does fair price even mean? It means buying a company at a price that reflects its true value or intrinsic value. You don't want to overpay for something that's not worth it. Trust me, I learned this lesson the hard way. I once bought a bunch of cheap stocks, and that ended up being completely dumb. Let's just say I lost more money than I care to admit. Trust me, if buying a cheap stocks will make you rich, you can just Google and invest in a bunch of cheap stocks, and we would all be living in the mansions and driving Lamborghinis by now, right? I hate to burst your bubble, but there's a reason why those stocks are cheap. It's like finding a discounted sushi roll at a gas station. Sure, it might seem like a great deal, but do you really want to risk getting food poisoning just to save a few bucks? So the truth is, cheap stocks are often cheap for a reason. They might be low quality, have poor financials, or be in a dying industry. So unless you are a gambling addict, it's probably best to do your research and invest wisely. Don't be like that guy who bought 1 million shares of Blockbuster in 2021.
Oh boy, yikes.
So what did I learn from that experience? I learned that investing isn't just about buying the cheapest stocks that you can find. It's about finding great companies that are undervalued by the market. And that's exactly what Warren Buffett does. By focusing on buying wonderful companies at a fair price, Warren Buffett avoids the pitfalls of investing in the fair or mediocre companies that may appear cheap, but are unlikely to generate significant returns in the long run. On the other hand, you don't want to overpay for a great company either. A fair price is important because it reflects the company's intrinsic value. Determining a company valuation can be a complex process that involves analyzing the financial data, market conditions, and future growth potential. If you want me to make a video to explain this, please comment below. Investors who buy stock at a price that is significantly higher than the company's intrinsic value may experience significant losses in the long run as the market corrects itself. It's all about finding the sweet spot. Lesson 4. Stick to your happy zone. Have you ever invested in a company you don't understand? I sure have, and it didn't end well for me. I invested in a tech company without knowing anything about the industry. Needless to say, it didn't take long for me to lose all my money. That's why I learned an important lesson from Warren Buffett: stick to what you know. And don't get me wrong, you certainly don't need to have a PhD brain to do well in the stock market. Warren Buffett is famous for sticking to his happy zone, which means investing what he knows. In other words, he doesn't invest in things that he doesn't understand. A happy zone is a place where you feel comfortable and confident in your investments. It's like that cozy spot on the couch where you binge watch your favorite show. It's the businesses and industries that you know like the back of your hand. The ones that make you happy and that you can talk about all day long. You don't want to invest in something just because everyone else is doing it or because you think it will make you rich quick. And let's be honest, we have all been guilty of investing in something that we knew nothing about just because it was the hot new thing. Trust me, investing in cryptocurrency just because Elon Musk tweeted about it is not a good idea. One of the Warren Buffett's most successful investments is Dairy Queen, a fast food chain that he invested in because he loves ice cream and he understands the business. He knew it was a solid investment and it paid off big time. Investing in overhyped industries can be dangerous. Remember the dot-com bubble? People were throwing money into IT stocks and it seems like everyone was getting rich quick. But then, just like that, the bubble popped and investors were left with empty pockets and broken dreams. Warren Buffett saw the dangers of investing in overhyped industries and avoided the IT stocks during the dot-com bubble. Finding your own investment style is crucial. We all have different risk tolerance and investment goals. Some of us are more conservative while others are willing to take on more risks. Warren Buffett's investment strategy may not work for everyone, but certainly is a good starting point. Lesson 5. Warren Buffett's 4 investing rule. We get excited enough to commit a big percentage of insurance company net worth to equities only when we find: number 1, businesses we can understand; number 2, with favorable long-term prospects; number 3, operated by honest and competent people; and number 4, priced very attractively. Warren Buffett, 1978. Luckily for us, Warren Buffett laid out his 4 big rules for investing success in Berkshire Hathaway's shareholder letter more than 3 decades ago. Rule number 1. Only invest in business that you understand. We talked about this in lesson 4. Rule number 2. Focus on businesses with good long-term prospects. Basically, you want to invest in companies that can stand the test of time, not ones that are flash in the pan. Investing in the one-hit wonders is like betting all your money on a one-hit wonder pop star. Sure, they might have a catchy tune, but will they be around long enough to make a return on your investment?
No, probably not.
Don't be tempted by the latest fads of trends that may fade away soon. Follow the example of Warren Buffett himself. He invested in American Express back in the 60s and still holds a large stake in the company. That's what I call long-term prospect. To know if a company has a good long-term prospect, there are several factors that you can consider. Firstly, make sure the company has a moat. No, not the things around the castle. A sustainable competitive advantage. This means they have something that sets them apart from their competitors, like a loyal customer base or unique products or services that are difficult to replicate, maybe a secret sauce recipe. Secondly, check their financial health. If they are drowned in debt, you might want to swim away because they drag you down with them. Thirdly, Make sure they have a track record of stable and growing earnings. If they have been making bank for a while, they are more likely to keep that money train rolling. And lastly, don't forget about the management team. You don't want to invest in a company run by a bunch of clowns who can't even make a decent balloon anymore. And that comes to our rule number 3. Investing in companies with owners and competent managers. This one seems like a no-brainer, right? But you will be surprised how many companies have managers that are about as honest as a politician in an election year. But not the companies Warren Buffett invests in. He famously invested in Geico, a company known for its quirky commercials, and more importantly, its honest and competent managers. And let's be real, anyone who can make car insurance funny has got to be doing something right. Right?
Yeah. Right.
There are a few steps you can take to do your own due diligence. First thing first, take a good look at the CEO. They are like the captain of the ship, steering the company towards success or failure. If the CEO looks like they couldn't navigate their way out of a paper bag, it might be a red flag. On the other hand, if they seem like they know what they are doing, that's a good sign that the company is headed in the right direction. But don't just stop at CEO. Do some research on the rest of the management team too. Have they accomplished great things? Or have they just managed to avoid getting fired for a long time? Remember, you want to invest in companies with owners and competent managers, not a bunch of mediocre middle managers. And if you want some extra reassurance, check out Team Invest. They are a group of successful business leaders, professionals, and investors who have collectively been around longer than the pyramids. Well, maybe not that long, but you get the point. They only invest in companies with management teams they have confidence in, so you know they are not messing around. Okay, rule number 4, only invest in attractively priced stocks. In other words, don't be a and overpay for a stock just because it's popular. You wouldn't pay $100 for a pair of shoes that are on sale for $50, would you? Well, maybe you would. I don't know your life. But Warren Buffett wouldn't. He invested in the Washington Post when the stock was undervalued, and he made a killing when it became more popular. So don't be a sheep, be a sheepdog. Wait, that's not right. You get the idea. Now you might be thinking, okay, those are some great rules, but how have they helped you? And how can they help me? Well, let me tell you, these rules have been instrumental in my own investing success. By following Warren Buffett's lead, I have been able to invest in companies I understand with good long-term prospects, owners and competent managers at attractive prices. And it's paid off. So if you take these rules to heart, you will be well on your way to investing success. If you want to move your investment journey to the next level, with SFA online stock investment class, you can learn how to apply these rules to your own investing strategy. Not only will you have access to the class, but you will also have access to the mentors who can guide you through the investing process outside of the class. No more feeling lost